Good morning, everyone. What is a stock market? At its core, the stock market is a vast global network of exchanges where investors buy and sell shares of publicly traded companies. Think of it as a giant marketplace, but instead of vegetables or clothes, the items for sales are tiny slices of ownership in corporations like Apple, Tesla, and Coca Cola. These slices are called stocks or shares. The stock market is a dynamic financial ecosystem where investors buy and sell ownership stakes, called shares or stocks, in public traded companies. It serves two primary purposes: enabling companies to raise capital for growth and allowing investors to participate in corporate profits and value appreciation. When a company wants to raise money to expand, innovate, or pay off debt, it can decide to go on public through an initial public offering or IPO. This is when it first sells shares to the public. Once these shares are available, investors can trade them among themselves on the stock exchange. The company itself doesn't receive money from these subsequent trades because the transaction is between the buyer and the seller. The prices of these shares are constantly fluctuating due to the fundamental economic forces of supply and demand. If more people want to buy a stock, the demand increases, so the price goes up. Conversely, if more people want to sell a stock, the demand decreases and the price falls. This dance of buying and selling is influenced by a multitude of factors, including a company's financial performance, broader economic conditions, industry trends, and global events. The stock market serves two critical purposes. For companies, it provides access to capital to fund growth without taking on debt. For investors, it provides an opportunity to share in the profit of those companies. If you own a share of a company that grows and becomes more profitable, the value of your share typically increases, and the company may also pay you a portion of its earning called a dividend. In essence, the stock market is a powerful engine for economic growth. It connects those with capital, who are called investors, with those who need to build businesses called companies, fostering innovation, creating jobs, and allowing individuals to build wealth over a long term. However, it is inherently volatile, with prices rising, which is called a bull market, and falling, which is called a bear market, based on investor sentiment and real world events.